Hello everyone, this is Brian Rezny, President of Rezny Wealth Management. You know, every Wednesday, and of course we do replay our shows on Sundays and often during the week, we talk about your investment questions, we answer your questions, we answer your concerns. The most important about our show that helps you is giving you quality information without the conflicts of these Wall Street firms, the local person at the bank, the person pushing annuities on unsuspecting investors. We want to make sure you make good financial choices and get real quality information. So again, we're not a Wall Street firm. We're not the local guy at the bank. We don't hawk or sell annuities. We work for our clients 100% as a fiduciary. If you don't understand what that is, go to our website, reznywealth.com, and download our free report, your number one investment and retirement risk. It's available free on our website. I wanted to start off with that because a lot of the questions that I keep getting, not only my TV but my radio shows, is about the advice that people are receiving from their Wall Street firm, which often is no advice at all, and it's really just sales and propaganda. So make sure the advice you're getting is coming from a fee-only fiduciary, a real money management firm, not somebody who seems and appears to be nice, but doesn't work in your best interest. That's where the fiduciary versus suitability comes in. By the way, big news announcement. The SEC, the Security and Exchange Commission, just announced a groundbreaking rule. What this basically means is this. SEC is requiring FINRA, who governs and oversees brokers and broker-dealers and Wall Street companies, that they can no longer expunge their bad doings from their records. For years and years and years, brokers and brokerage firms were able to expunge the wrongdoings they did against you, the client. So if you did go to FINRA and check out your broker or brokerage firm, a lot of their misdoings or bad doings against you would not actually be on there because those bad doings were taken off the record. Fortunately for you, the investor, the SEC has stepped to the plate and they've passed new rules that basically govern FINRA and basically state that FINRA can no longer expunge these bad doings to you. So this way, at least you can check out these brokers and understand that Wall Street doesn't work for you. They don't work in your legal best interest. They work under suitability. Their interests are far different than you, the investor. Go to my website, reznywealth.com. Download that free report. You can also read the article at sec.gov or finra.org. You know, I want to talk a little bit today about investing and what's going on with some of the recent upheavals in the world. You know, Russia is one of those. Israel's another one. These are events, unfortunately, that happen, and they're going to happen again in the future, next year and next decade. These are constant geopolitical events that affect the markets. I want to talk about that. What investor behaviors undermine investment performance? The bottom line is this. When you listen to news like about Russia and Crimea, like about Israel, and if you're making investment decisions off of that, you're making the wrong decisions. While these are not good events, obviously, for these countries and the people surrounding that, making investment decisions because Russia may go into Crimea or there's missiles going off in one country to another really have very little long-term impact on the investment markets. It's usually noise, and investors who invest based upon emotions and these kind of news articles really are making bad decisions. So again, geopolitical events happen. Do not base your investment decisions off of those events. Why do you need an adaptive investment strategy to grow and protect your portfolio? Let me tell you what actually works. Most investors, first off, pick investments because they've heard of them, or they listen to what happened with Russia, so they make a knee-jerk reaction to sell all their investments, as an example. That doesn't work. What you do want is an adaptive strategy based on relative strength. Relatively stronger investment sectors, not just the stock market, but look at all investment sectors, historically have outperformed and reduced risk in a portfolio. You want a strategy that's adaptive, meaning it can change with changing conditions in the economy on the intermediate to long term, not short-term news. So at the end of the day, look at all investment sectors, use assets in the portfolio that are relatively strong. Sometimes that does mean going to cash or safe alternatives when the economy is actually slowing fundamentally, not because of news out of Russia or Israel or something of that fact. Remember, adaptive. Also, part of your portfolio strategy needs to be risk managed. What that means is you can handle little bumps in the road. You don't want to ride financially when the economy is deteriorating down 30 to 50%. Risk management is important in a portfolio. Reduce risk when you should, not when the news service is basically giving you headlines that make you make rash, emotional decisions. Investors spend far more time searching, not researching, or following an investment strategy. No risk management or when to sell. Let me explain. If we have 10 or 15 new potential clients come into our office, most of those investors will tell us they pick investments based upon they've heard of them, with very little research. Most of them don't follow an investment strategy. That's detrimental to your returns, increases your risk, of course, and it's going to hurt your retirement. The other important thing is a sell discipline. When do you actually sell an investment? I'll give you an example. A number of calls I've received recently on my TV and radio show have been about a stock called Groupon. Groupon's a company that basically markets and basically sells coupons to you, the investor, for cheap money. The company IPO'd, let's say 3.5 years ago, and it's been on a constant slide down. Fundamentally, this company's a wreck. Technically, it's in a downtrend and it's a wreck. But investors want to buy Groupon because it's trading at a 52-week low. Just because a stock's dropped 80% doesn't mean it's a good bargain. It could go out of business. I firmly believe that investors who buy something because they've heard of it or because the price appears to be cheap maybe are not really doing the research they need to make. So at the end of the day, researching a real investment. Why are you going to buy it? But before you buy it, like Groupon, what's going to give you the reasons to sell it instead of riding Groupon all the way down 80 or 90%? Remember, what you buy today may have to be sold tomorrow or next year or 10 years from now. Without a detailed sell discipline, you're going to make less money and take more risk in your portfolio. Making a return on your investments, it all boils down to two things: knowing what works and doing what works. Let me give you a specific example. Traditionally, again, no guarantee to the future, but traditionally, small cap stocks outperform large cap stocks as an independent sector over rolling 3 and 5 year time frames. That's fairly typical. There are times, though, when small caps will lag temporarily large cap stocks. Does that mean you should sell small cap stocks? No. As long as the fundamentals of the U.S. economy are growing, that's actually a time you want to add to those stocks. But what most investors will do is they will overload the boat on large cap stocks and basically buy what's already expensive and what's already outperformed temporarily, when the actual big winner might be buying small caps when they've underperformed for a short period of time, only to get steam up and outperform or outsurpass large cap stocks. Too many investors, again, don't follow an investment strategy and they don't have a sell discipline. Both of those will be detrimental to your portfolio returns and add risk to your portfolio. Remember, your broker, your Wall Street firm, they're not managing your money unless you're dealing in a registered investment advisor account, not a brokerage account, unless you're in an investment advisor agreement with an advisory firm like Rezny Wealth Management. You're in a brokerage account and you are on your own. So don't think that warm and fuzzy call from Mr. Broker is actually managing your money. They're there to sell you the next hot investment, which is hot for their account, not necessarily yours. I want to go to the phone lines and take some of the calls and questions from our TV listeners. By the way, if you want to send me a question, send it to Brian Rezny at ReznyWealth.com. We'll do our best to answer all the questions that we do receive. And I do encourage you to go to my website, ReznyWealth.com. You can sign up for instant email updates. Anytime that we have a specific and important article or something going on in the investment markets or the economy that you should know about, you get an instant email into your email box. Just go to my website. You just need your email address. You plug it in and you're signed up and you get all kinds of great information from our firm, and it's free. What is the difference, Larry in Miami, what is the difference between mutual funds and closed-end mutual funds? Great unbiased show, thank you. Larry, great question. Mutual funds, basically, a lot of investors invest in these because brokerage firms love to sell them. It doesn't mean that's best for your account. But at the end of the day, a mutual fund basically is a group of investments that own specific, whether stocks, bonds, or different assets within a portfolio. And a mutual fund can keep adding more and more shares and more investors to that pile. A closed-end mutual fund only issues a limited number of shares, and that's it. So it's much different. Closed-end mutual funds are also quite a bit more complicated often than a mutual fund, because a lot of closed-end funds deploy leverage, and leverage can increase your risk, and of course it has the opportunity to increase your upside, but what I often see is it decreases your returns and often increases the downside. So leverage is one. Also, if you look at closed-end funds, they trade at either premiums or discounts to the fair value of the assets. And there's other more moving parts in closed-end funds. Most investors would be better suited not in mutual funds or closed-end funds, but again, you need to do your own research, but in what's called an ETF, exchange-traded fund. Much cheaper, can track a base index, and I think those are much more helpful to the individual investor like yourself. Eric in Naples, Florida. Are bank loan funds a suitable money market replacement? Eric, no, they're not. Bank loan funds, or floating rate funds as they're called, are basically short-term bonds. And these are typically 90-day paper. So it's kind of like a bond fund, but instead of being 3 or 5 year duration bonds in the portfolio, bank loan funds are traditionally around 90 days in length, so very short term. That short term gives you less fluctuation when interest rates go up and down. So they're a little bit more stable from an interest rate environment, which is good and actually not a bad place to be right now given how low rates are. But they're not a suitable replacement for a money market account. If you're putting money into a money market account, you basically want something that's FDIC insured and basically has a net stable asset value, meaning it can't go up and down. Even bank loan funds can have some short-term fluctuation, so do not use a bank loan fund as a money market replacement. In my opinion, that would be a big mistake and you'll be taking on more risk than you should. Tom, what is the rollover of bonds in what is the role of bonds in a portfolio? Do you believe in the weight of bonds based upon age? I'm 65. Tom, great question. There's a lot of mutual fund companies and some of the Wall Street firms that really push this. And what you're asking is, if you're 65, they push that you should have 65% of your money in bonds, meaning the weight of bonds should be based upon your age. If you're 70, you should have 70% in bonds. I think that is a huge mistake for the investor. Traditionally, you want to look at bonds as a different asset compared to other non-correlated assets, let's say like the stock market. But remember, bonds can go up and down in value just like the stock market can. When rates go up, bond values go down. With rates being at an ultimate, really a low point in the last, let's say, 40 years, if you overloaded your portfolio and you had 65% in bonds, let's say, given your weight and age, and if interest rates, let's say, just go up 1 percentage point on a 10-year bond portfolio, you could actually drop 10 to 12% in value. So you're taking a lot of risk. What I would say to you is this: there's other asset categories unrelated to bonds and the stock market. What you really need to do, instead of just taking blind advice where everybody should be painted into a corner and you should have a 60-40 mix or whatever that weight should be, you really need to have a strategic portfolio structure that basically looks at the risk profile that you can assume on the short-term volatility, but still gives you the income needs on that short term. What I typically do as an investment firm, there's times we could be very heavy in cash and bonds, but on short-term duration, which are much different than intermediate or long-term duration bonds. So I don't believe in the weight of age. I think there's other alternatives, and I think investors who put too much money in bonds over the next decade are going to have miserable returns if rates keep moving up, and could actually take a lot more risk than they realize in their portfolio. I'm going to take a short break. I'll be right back with your calls, your questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Every single week I receive dozens of phone calls on my TV and radio show from disgruntled investors who were sold an annuity that didn't belong in their portfolio. Don't let your retirement be taken to the woodshed. Read my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Go to ReznyWealth.com right now. And we're back, and we're taking your questions, of course, about any of your investments, whether it's about stocks, bonds, mutual funds. We want to help you make better decisions around your portfolio. You know, when we started doing this show, the reason we did it is one reason, which is to help you, the investor, avoid Wall Street conflicts of interest and bad investment advice. Folks, I would encourage you to visit our website, ReznyWealth.com. We do have offices throughout Florida, Naples, Fort Myers, Boca Raton, and, of course, Coral Gables. Contact us if you're concerned about your portfolio, if you're concerned about the advice you're getting, if you're realizing that Wall Street firm is not doing right by you, if somebody's trying to sell you an annuity, avoid that advice. It's bad. Call our firm for consultation. We're a fee-only money management firm providing exactly what our clients need, which is active money management, which includes risk management. Don't go it alone. Call us for a second opinion. We'd love to help you rebuild and make sure you have a comfortable, safe retirement. I want to go to my next question. Terry in Boca Raton, Florida. What do you think of all the negative bubble headlines you hear about every day? What should an investor do? Terry, that's a great question. I can tell you one thing. The amount of headlines that come out daily, and dozens of times a day, these negative headlines where Dow 6,000, some guy's predicting the market's going to drop 70%, or market's going to crash 30% in the next 6 months, or whatever it is. This is all propaganda. These people have no idea what they're talking about. I never give predictions about market crashes. What I will tell you is hard facts, which is financially. Markets go down when the fundamentals start to get weak and the gross domestic product starts to roll over in this country. To keep it simple, right now the economy, generally speaking, is growing. We're in this nice uptrend. Corporate earnings have been quite good. In fact, if you look generally speaking this year, you're seeing about a 5% revenue growth and about a 10% earnings growth on companies that have reported so far. That is pretty darn good. So we're not seeing contraction, we're actually seeing a little bit of expansion. When things start to roll over, that's when things will actually start to look bad, and that's when a firm like us will start to exit risk assets and start to sell things that should be sold in a portfolio to help protect against catastrophic meltdowns of these 30-40% that you typically see in a recession. These negative headlines are there for one reason. It makes you trade more, spend more money with your Wall Street firm on commissions, and it makes you lessen your portfolio, and ultimately they'll give you more risk in your portfolio. Negative headlines, negative news, daily news pretty much you hear all the time doesn't belong in your investment decisions. It's emotional, it's knee-jerk, and again, if you're using that to make decisions, you're going to hurt your portfolio and your returns are going to suffer greatly. Todd in Naples, Florida. Are you concerned about equity valuations? Todd, no, I'm not. We look at, as a firm, we don't just look at the stock market, but we look at all investment asset categories, whether it's real estate, oil, currencies, bonds, and so on. But if we look at the valuations of the equity market, generally speaking, if I look at the S&P 500, it's trading at around a 16 PE ratio to this year's numbers. That's not high and it's not low. It's kind of in the average. And again, the economy's growing and earnings and revenues are growing. So does that mean that we're going to keep going straight up? No. We might have this kind of pause that refreshes or go down a little bit and then maybe resume the uptrend. But generally speaking, if earnings are growing, if revenues are growing, which helps drive earnings, then we have a great opportunity for things to keep going higher. One of the things I was discussing with a client actually today is in regards to the expansion of the U.S. economy. Traditionally, coming out of recessions, the economy grows quite fast and then starts to slow down a little bit. This last recession in 2008, we had a very slow recovery. Because of that slow recovery, we might have a potential bull market for a much longer expansion period because coming out of the chute was slower. So like 1982, let's say, to 2000, that lasted 18 years, that expansion. we might see the potential for another 6 or 8 or 10 years in this economic expansion because it's been slower out of the chute, which is actually healthy and gives great opportunity for investors who are on the right side of investing and are not basing their decisions on emotions, but pure facts and logic. Mark in Sanibel, Florida. Gabelli Utility, GAUGX, pays a huge dividend. What do you think of that fund? Great question. Not a fan of the fund. The fund's done okay. It basically buys utilities, and it does pay a decent dividend. What I would say to you is this: instead of looking at buying that fund that's got a pretty high expense ratio, take a look at the XLU. This is an ETF, again, symbol XLU. It basically buys a basket of utilities, kind of similar to that fund. It's actually outperformed that fund long term. I like it more. But I'm going to preface it with this. Utilities have been on a tear so far this year, and they are pretty much greatly overvalued. While all the equity markets are not overvalued, I think utilities are way overvalued, probably by 20 to 30%, because investors have plowed into utilities for the higher dividend, pushing up the price. So I think utilities have more risks than the general market. I would not be buying utilities at this point in time. And we're starting to see some negative technical readings in addition to expansive fundamentals on utilities. But if we're going to look at either one of those two investments, I'd prefer the XLU, but I don't think right now is the time you want to invest in utilities. I think they're far too expensive and they're far too risky for your portfolio. Sal in Naples, Florida. How can I generate income in a low-yield world? I'm sitting on a lot of bonds paying 3% and cash paying nothing. Sal, that's a great question. Bottom line is this: if you're all in bonds and cash, why? There's other asset categories that pay growth or dividend and income unrelated to the bond market. What I fear is you're buying what you perceive to be safe, and bonds are not safe. Bonds can have a lot of volatility from time to time, and depending on what kind of bonds you buy, you might take a lot more volatility for basically very little upside potential in dividend or growth. What I would say to you is you probably need professional investment management. I would suggest, Sal, you contact our office. We do have an office right here on the West Coast on either Naples or in Fort Myers. Call us for a consultation. Let's sit down. Let's see what you're doing specifically and see if we can't help you better manage your portfolio for a better income stream and upside potential in your portfolio. Sam in Fort Myers, Florida. Can strong corporate earnings spark a renewed rally in stocks? Yes, it can, Sam. Remember, earnings growth often drives equity prices higher. Equity prices are fairly reasonably valued. If we can keep getting earnings and revenue growth, yes, it can spark a renewed rally in the stock market. I'll tell you this, last year, 2013, the markets, generally speaking, were pretty much on fire. This year, they're kind of flattish or up a little bit. You often see it, and again, doesn't mean that we might not be up a lot more by year end or down some by year end, but traditionally, when you have a big outstretched year like last year, sometimes the following year might be a little bit more subdued. What that means is this: this year might be subdued, and if earnings continue into next year, you might see a big spark up and the markets actually go higher. I'm not saying sit on the sidelines till next year. What I'm saying is sometimes just a pause that refreshes and the markets kind of bounce around until they take the next step. But if you wait until they take that next step, you might miss most or all of the next movement on the upside. Again, generally speaking, we look at the markets on a fundamental, meaning how are they doing on our earnings growing and revenues growing for corporations, and technically, are we in this nice uptrend? We like what we're seeing. Again, our positions can change at any time, and so can our views, because the markets will change over time. But generally speaking, the economy is doing pretty darn good. Not as good as people always want, but that's why most people never make money in their portfolio, because they don't know when to invest or how to invest. Paul in Plantation, Florida. I was pitched an Allianz hybrid annuity for income for life for my 401k plan, 575k rollover. What should I be leery of? Paul, you should be leery of annuities, period, whether it's Allianz or any of these companies. I do not like annuities one bit. Annuities are sold by annuity salespeople who work under suitability. They don't work in your best interest, and I know the guy or the woman was really nice, probably bought you a free steak dinner at the local steakhouse, and they're probably telling you you're going to make 8% returns and there's free money bonuses. Those are all lies and sales techniques in order to get you looped into buying an annuity. There's no free money and there's no 8% returns in annuities. You need to read the fine print, and once you read the fine print, you'll realize there's no 10% free money and there's no 8% returns. Your money does not belong into annuity number one. Whether it's that annuity or any of these annuities, they carry stiff surrender penalties to get all your money out. Some of these penalties on these annuities last as long as 22 years and up to 22% of your money to get it all out. That's ridiculous. Any investment that is of quality never has a front end or back end load. You would never need to buy one of those. I would suggest you call my firm for a consultation. There's a big difference when you're dealing with a fee-only money management firm like us. We can manage the money, help manage the risk, help you develop a successful retirement without being sold into a pile of junk in the annuity market. I would also suggest you go to my website, download for free. I've written a groundbreaking report. It's on my website for free. It's called Why Annuities Are Dangerous to Your Wealth and They're Dangerous to Your Retirement. No inflation protection, surrender fees that are incredible, expense ratios that rob your return. Read more about why annuities are dangerous to your wealth and retirement. You'll be glad you did. Do not buy the annuity. Call us for a second opinion. We'd love to help you and really work in your legal best interest as a fee-only fiduciary. Folks, I'm getting close to out of time. Again, if you have questions about your portfolio, send us to Brian Rezny at ReznyWealth.com. We'll try to answer those, of course, on the next TV show. We also do a live radio show every Sunday throughout Florida from 10 a.m. to noon. Go to my website to learn more about it at ReznyWealth.com. If you're tired of set it and forget it, Wall Street conflicts of interest, and poor investment advice, call my firm for a consultation. Our number's at the bottom of the screen. There is a difference. We invite you to experience it. Don't settle for bad investment advice. Call my firm now. Go to our website, ReznyWealth.com. Sign up for our free email alerts, free at ReznyWealth.com. I'll see you next week.